Good morning, everyone. My name is Gustavo, and it is a pleasure to have you joining us for our second quarter 2026 earnings video conference. As always, Milton will walk you through our performance, and afterwards we will have our traditional Q&A session during which analysts and investors will be able to interact directly with us. Before handing the floor over to Milton, I would like to share a few instructions to help you make the most of today's event. For those accessing the webcast through our website, there are 3 audio options available: the entire content in Portuguese, the entire content in English, or the original audio. The first 2 options offer simultaneous translation. To select your preferred option, simply click on the flag icon located in the upper left corner of your screen. Questions can also be submitted via WhatsApp to the number displayed on your screen. Today's presentation is available for download on both our hot site and, as always, on our investor relations website. With that, I will now hand you over to Milton, and we will reconvene later for the Q&A session. Milton, over to you.
Good morning, welcome to another earnings release as we discuss our second quarter 2026 results. You will see an executive presentation focused on the key drivers of our results, with the objective of leaving ample time for our traditional Q&A session. We delivered a strong quarter with consistent results, high profitability and excellent credit quality indicators, very much in line with the consistency we have been delivering over recent quarters. Let's move directly to the numbers. This quarter, we delivered recurring net income of 12.4 billion reais, representing growth of 7.8% compared to the second quarter of last year and of 1% compared to the previous quarter. This was therefore another very solid result. How does this translate into profitability? On a consolidated basis, ROE reached 24.3%, while in Brazil it reached 25.7%. As always, we also present profitability adjusted to a CET1 capital ratio of 11.5%, which is close to where we believe the market operates and is also our minimum capital appetite threshold. On this basis, consolidated ROE would have reached 25.1%, while ROE in Brazil would have reached 26.7%. This is perhaps the most comparable metric across earnings releases, and it demonstrates our ability to generate strong returns not only in Brazil, but also on a consolidated basis. Turning to the loan portfolio, we posted healthy growth, reaching 1.522 trillion reais, up by 2.7% quarter-over-quarter, and by nearly 10% year-over-year. This reflects our ability to grow with quality, supported by sound portfolio dynamics and disciplined capital allocation. Moving on to NII with clients, we also delivered a very solid result of 32.6 billion, an increase of 3.3% compared to the first quarter of 2026 and of 5% compared to the second quarter of 2025. It is important to highlight this acceleration. Results were very solid, and I will provide more detail shortly. Moving to non-interest expenses, growth remained well under control at 3.1% year-over-year. It is worth remembering that we have been investing continuously for many years, always with a long-term perspective. These figures demonstrate not only our ability to continue investing in the business with quality, but also our ability to pursue efficiency wherever it needs to be found on a daily basis. This reflects strong cost discipline across the organization. All of this has translated into a Common Equity Tier 1 ratio of 12.3%, once again demonstrating a very solid and high-quality capital base, with an increase of 30 basis points compared to March. It is worth remembering that we did an early dividend distribution at the end of last year, which meant that we entered 2026 with a highly optimized capital position. We also had the regulatory phase-in effects, which still had an impact during the first quarter, and yet we continued to generate capital with strong quality. I will return to this topic in more detail later in the presentation. Turning back to the loan portfolio, I will walk through the figures from the bottom up, as that may be easier to follow. In Brazil, the portfolio grew by 9.6% year-over-year and 2.6% quarter-over-quarter, which is very healthy growth. large companies posted growth of 10% year-over-year and 4.4% quarter-over-quarter, once again reflecting strong discipline in capital allocation and expected returns. These are very long-term balance sheet transactions, which makes disciplined capital allocation particularly important. Next, let me provide more details, starting with micro, small, and medium-sized companies. We posted healthy growth of 1.5% in the quarter and 11.6% year-over-year. More important than growth itself, however, is the quality and risk profile of this portfolio. The portfolio of government-backed programs grew by 7.2% in the quarter, while originations increased by 47.3% over the same period. Once again, this reflects our discipline in delivering the best products under the best conditions, while maintaining strong risk management and capital allocation standards. Payroll lending has continued to be a very important growth driver for us, particularly private payroll loans under the new product. The overall payroll loan portfolio grew by 3.5% in the quarter and 11.7% year-over-year. When we take a closer look at private payroll loans, the portfolio expanded by 14.3% in the quarter and 90.1% year-over-year. From the outset, we were able to capitalize on this opportunity very effectively, delivering value to our clients while generating strong and consistent growth, with delinquency remaining fully under control. This also affects the dynamics of our personal lending portfolio, since for clients who are eligible for private payroll loans, particularly formally employed workers, we have increasingly prioritized this product over traditional unsecured personal lending, due both to its pricing advantages and its priority in the repayment structure. Finally, turning to mortgage lending, it is important to remember that our funding structure is differentiated relative to the market, enabling us to remain highly competitive in this segment while serving our clients effectively and allocating resources efficiently. The mortgage portfolio grew by 3.9% in the quarter and by 13.3% year-over-year, reaching 152 billion. In fact, the mortgage portfolio has now surpassed our credit card portfolio, which has historically been one of our most important portfolios at approximately 150 billion. Mortgage lending is a long-term product that fosters strong client loyalty and reciprocity, which is why this strategy is so important for us. Today, we are the largest private sector bank in this segment, with 36 billion reais in originations over the last 12 months and a 55% market share among private banks. Once again, this demonstrates how our funding structure, our clients' investment profile, and our funding capacity allow us to sustain a mortgage portfolio at these levels. Now let me turn to NII with clients and highlight 2 points. First, total NII increased by 1.1 billion reais, representing growth of 3.3% in the quarter, including working capital and other effects. We posted growth in the working capital and other categories, in addition to the impact of investment rates, and were able to monetize our capital very effectively, reaching 3.9 billion in working capital during the quarter. When we look at core NII, we see growth of 800 million reais, or 2.9% in the quarter, broadly distributed across all components. Average volumes contributed positively. Product mix was broadly neutral for margins. Liability margins and asset spreads were slightly positive, and we also benefited from a calendar effect, as this quarter had one additional calendar day, which positively affected liabilities. Latin America and other also contributed positively. So as I mentioned, this was a broadly distributed result, demonstrating our ability to generate core NII alongside an effective strategy for monetizing working capital and supporting the bank's capital generation. When we translate NII into margin percentages, particularly risk-adjusted NIM, which is the way we manage the balance sheet, we have positive news to share. As I always say, generating a very high margin only to give it back through credit costs is not a sensible capital allocation strategy. What we have shown consistently is our ability to manage margins with discipline and consistency. Risk-adjusted NIM reached 6.2%, representing a slight increase of 10 basis points in the quarter on a consolidated basis. The same dynamic was observed in Brazil, where NIM increased from 6.6% to 6.7%, reflecting our disciplined portfolio management and delivering very solid results. Therefore, this is very positive news on the margin front. Turning to NII with the market. Although results may appear stable compared to previous periods, I believe that we are all aware of all the challenges we have been facing in financial markets and the level of volatility we have experienced, both in local and global markets. Even so, we delivered another solid quarter, supported by consistent risk management. This discipline and the quality of the results we deliver are extremely important. As a result, NII with the market reached 900 million reais. We also continue to incur costs associated with capital index hedge ratio, but as part of our strategy to protect our capital position and enhance earnings predictability, we continue to believe that this remains the appropriate approach for the bank's balance sheet. Even considering this cost, we delivered a very solid performance in NII with the market. Turning to commissions, fees, and results from insurance, I will once again comment on the figures from the bottom up. You will see that results from insurance, pension plans, and premium bonds increased by 8.7% year-over-year and 12.8% compared to the first half of 2025. Our core insurance operation continues to grow very consistently on both a quarterly and year-over-year basis. We have delivered many consecutive quarters of growth, with results at a substantially different level compared to 5 years ago, reflecting very strong progress. Moving on to advisory services and brokerage, revenues increased by 32.5% year-over-year and by 25.3% in the first half compared to the same period last year. This line is largely composed of fixed income transactions, and our approach has been one of strict capital allocation and risk discipline. As a result, many of these transactions are ultimately retained on our balance sheet, and what we evaluate is the expected return profile, ensuring that returns remain consistent and aligned with our cost of capital, while also carefully assessing the type of risk we are retaining over the long term, considering both fixed income market pricing dynamics and credit risk. Therefore, we remain very comfortable with the quality of the assets that have been retained on our balance sheet. Moving on to asset management, revenues grew by 7.3% year-over-year. More importantly, despite not being an exceptional quarter for performance fees, we still achieved 11.0% growth in the first half compared to the same period last year. There are some lines that we deliberately continue to disclose, particularly current accounts for individuals, which declined both in the quarter and year-over-year, to demonstrate that this is precisely the direction we expect. We have been redefining our current account packages in an effort to serve clients more effectively, while simultaneously increasing customer lifetime value and reducing friction in our customer relationships. This is why we continue to disclose this line separately, providing visibility into the significant transformation taking place in our revenue mix, with revenues becoming increasingly more sustainable, higher quality, and supportive of greater customer lifetime value. Revenues from card issuance are closely linked to the risk profile of the portfolio we have been originating. Over the last years, we carried out a very significant de-risking process, and today we operate a portfolio with delinquency levels that are substantially below market averages, roughly half of the system levels, while delivering quality growth and double-digit expansion in the target segments where we have chosen to grow. Therefore, we are very satisfied with the quality of the results we have achieved. That said, as I mentioned previously, we have observed some moderation in this line throughout the year as a function of economic activity levels. I will discuss our guidance later on, but this is the line where we are making an adjustment. As I have mentioned in previous quarters, we already saw some risk that performance could trend closer to the lower end of the range. Therefore, we believed it was prudent to revise our full-year growth expectations this quarter. I will provide more details on this adjustment shortly. Turning to credit quality, we delivered another quarter of strong consistency. Looking at Brazil, consolidated NPL 15 to 90 days remained stable and fully in line with the previous quarter. In Brazil, the individual's portfolio also remained stable, at approximately 3.0%. In SMEs, we saw a slight increase, fully consistent with what I have been discussing over recent quarters. We continue to expect normalization of this indicator with the gradual stabilization of the grace periods associated with government-backed programs, which, as I previously showed, are highly relevant within our portfolio. We are now approaching the end of these grace periods. We should still experience an additional quarter of increases, particularly in NPL over 90 days, which I will discuss in greater detail shortly. Looking at long-term delinquency, the overall indicator remained stable, as did Brazil's indicator this quarter. These are very positive developments for cost of credit, particularly in an environment with household indebtedness increasing, household leverage rising, and interest rates remaining restrictive. Even under these conditions, we have been able to navigate the cycle with a high degree of discipline and consistency. Looking specifically at Brazil, delinquency in the individual's portfolio increased slightly by 10 basis points. But we have absolutely no concerns regarding this portfolio. I also wanted to provide greater transparency regarding the impact of the Desenrola program. We had 371,000 clients impacted and 1.1 billion reais in renegotiated loans, but the effect on our indicators was immaterial. To put this into perspective, the impact on cost of credit was 60 million reais during the quarter, while the impact on the delinquency indicator was only 2 basis points. Why am I highlighting this? Because we achieved a 12% market share in this program. When the program was launched, our expectation was to operate with approximately 10% market share. We performed somewhat better than expected, although the target customer profile, consisting of individuals earning up to 5 minimum wages, is not necessarily the primary focus of our portfolios. The key message, however, is that our risk management framework continues to perform with a very high level of quality, regardless of any specific program. In this particular case, the effect on our indicators was immaterial. This is the indicator I mentioned earlier. With SMEs increasing from 1.9% to 2.0%, we are still operating at levels that are significantly below those observed in the past, when this indicator ranged between 2.3% and 2.5%, and that is only natural. However, there is a mechanical effect related to the expiration of grace periods as government-backed programs mature. Previously, we benefited from these grace periods, as the denominator grew significantly without any impact on the numerator. As these grace periods begin to expire, we naturally see this increase in the indicator. Our best estimate is that this indicator should increase by another 10 basis points next quarter, reaching approximately 2.1%, which remains well below levels observed not so long ago, such as in September 2024. It is important to remember that the market is dynamic, but our current expectation is for this indicator to stabilize at around 2.1% over the coming quarters. Once again, this reinforces the fact that we are looking at a mechanical effect and not a source of concern, despite all the challenges we have been observing in the market. Therefore, delinquency indicators continue to provide very positive news. Regarding the portfolio by stages, I do not have any major highlights here. Stage 2 and Stage 3 portfolios remain broadly in line with expectations. However, I would like to draw your attention to the Stage 2 coverage ratio, particularly the reduction observed this quarter in the company's portfolio. It is important to note that we do not manage the business by stage classification. Our management approach is based on expected loss. Therefore, if you compare the sum of short-term delinquency, NPL 15 to 90 days, plus NPL over 90 days, with the share of the portfolio classified in each stage, you will notice that stage allocations are substantially higher. What happens is that, particularly in wholesale, when there are migrations from Stage 2 to Stage 3, or from Stage 1 to Stage 2, these effects become visible. This quarter, we experienced migrations of clients from Stage 2 to Stage 3. Typically, clients leave Stage 2 with a relatively high level of coverage when they are ready to migrate. And this affects the overall coverage ratio. Once again, this is essentially a mechanical effect that is fully accounted for in our projections and in our cost of credit, which I will discuss shortly. There is no specific issue behind this movement. In the MD&A, you will find the breakdown by retail and wholesale segments, but this remains a purely mechanical effect with no cause for concern. It simply reflects the natural migration of clients between stages, all of whom already had adequate provisioning levels. Turning to cost of credit, you can see remarkable stability in this series from the first quarter of 2025 through today, with cost of credit running at 2.7% of the portfolio throughout the period. This is an impressive level of stability. Naturally, nominal figures increase as the portfolio grows, which is why it is important to compare nominal growth in credit costs against the growth of the portfolio itself. That is exactly what we have observed. Cost of credit recorded only a slight increase, reaching 10.1 billion reais. As I mentioned earlier, the impact of the Desenrola program was immaterial both overall and during the quarter. Moving on to the renegotiated portfolio, it continues to operate at very comfortable and appropriate levels, although there are some specific effects worth mentioning. I had previously indicated that at some point, the nominal figures would naturally tend to increase. This is expected given the significant de-risking process we have carried out over recent years. However, we also have specific one-off effects, such as the inclusion of the Desenrola portfolio. Out-of-court restructurings and older restructuring plans that have recently been approved are also included in these figures, among other items. Therefore, this increase is driven by specific and isolated factors. What matters most is the relative indicator, which remains very well behaved and once again demonstrates the strength of our portfolios. Turning to non-interest expenses, the news is very positive. Commercial and administrative expenses declined by 0.5% year-over-year and increased 3.2% in the first half of 2026 compared with the first half of 2025, remaining below both inflation and collective bargaining adjustments. Looking at total Brazil expenses, growth reached 3.1% year-over-year and 4.1% in the first half of 2026 compared with the same period last year. This once again demonstrates our cost discipline across the organization and the meaningful progress we have made, particularly in those segments where we needed to improve efficiency in order to become increasingly competitive. This is a direct result of our management strategy, and we can certainly discuss it further during the Q&A session. Overall, I am very pleased with the progress we have achieved on this agenda. As a result of this strategy, the efficiency ratio reached 35.5% in Brazil in the second quarter and 37.4% on a consolidated basis. Looking at the first half comparison, we continue to make progress, improving from 35.7% in the first half of 2025 to 35.2% in the first half of 2026 in Brazil, and from 37.5% to 37.3% on a consolidated basis. Therefore, I am very satisfied with the efficiency ratio of the institution as a whole. It is also important to note that all expenses are included in this metric. There are no additional expenses outside the figures presented here, which further reinforces the strength and quality of the results we are delivering. All of this ultimately reflects our capital generation capacity. We generated 0.8% through earnings retention during the period. We had a 0.3% reduction related to dividends and interest on capital provisions, and a further 0.1% reduction from risk-weighted assets. As a result, we ended the quarter with a Common Equity Tier 1 ratio of 12.3%, a very strong and solid capital position, with further growth expected, which should allow us to have our traditional discussion regarding additional dividend distributions at the beginning of the following year. This clearly demonstrates the strength of our capital generation capacity. We also report additional Tier 1 capital at 1.5%. It is worth noting that the actual figure is 1.7%, but regulatory limits restrict the amount that can be recognized, which is why we present 1.5% here. This results in a very solid Tier 1 capital ratio and reinforces the strength of our capital generation base. Finally, regarding my comments on guidance, I have two observations to make. We maintained the previously disclosed guidance ranges, including loan portfolio growth, NII with clients, NII with the market, cost of credit, and non-interest expenses. The only change we made was to commissions and fees and to results from insurance, which, as I mentioned earlier, is closely linked to the level of economic activity. We revised the expected growth range to between 2% and 5%, whereas at the beginning of the year, we expected growth between 5% and 9%. We are making this adjustment to better reflect the trends we have been observing. If we see positive surprises in economic activity or attractive market windows, we will naturally seek to capitalize on them in the best possible way. However, we believe that making this adjustment is the most prudent course of action at this point. The second comment I would like to make is not a change in guidance itself, but rather a comment on the position of the guidance. If you recalculate the implied results, I would ask you to consider the effective tax rate at the lower end of the range, which reflects our best current estimate. If you run the math based on those assumptions, you will see that the implied bottom line remains unchanged. Despite the revision to fee income and insurance results, assuming the effective tax rate remains closer to the lower end of the range, the bottom line outlook is effectively the same. This once again demonstrates our ability to provide visibility and deliver consistent earnings, even if the contribution by line item ends up differing from our original assumptions. We still have 2 quarters ahead of us, with important challenges to navigate. The year is far from over, but we believe that we are very well positioned to deliver on our objectives over the next 2 quarters. As always, should anything change, I will communicate it to you in a timely manner. Well, everyone, as I stated earlier, these are very solid results. We delivered quality performance across all lines. I believe it is extremely important to look at the bank's balance sheet and, just as importantly, to understand where earnings are being generated. Above all, what matters is discipline and consistency, allocating capital effectively, generating appropriate returns on allocated capital, deepening primary banking relationships with our clients, increasing engagement, strengthening relationships, and managing a transformation process that is occurring at a pace we have never experienced before, whether in terms of cultural transformation or digital transformation. We have been able to execute and coordinate all these changes simultaneously. These are structural changes to our business models, carried out with a high degree of discipline, strong execution focus, and, most importantly, with a realistic understanding of the many challenges ahead. Both the macroeconomic and microeconomic environments require close attention. The level of indebtedness among both companies and households in a restrictive interest rate environment requires caution. Nevertheless, we have been navigating this environment successfully, always maintaining a long-term perspective. Thank you once again for your time and continued trust. I will now join Gabriel and Gustavo for our traditional Q&A session. See you shortly.
Olá, estamos de volta agora direto do nosso
Welcome once again from our studio for the Q&A session. We're going to start, and beforehand, this is a two-language session. We're going to answer the questions in the language that they're made. Should you need any support, our platform has the options for the audio in Portuguese, English, or the original audio without translation. You can submit your questions via WhatsApp. First question that comes from Bernardo Gutmann, XP Investments. The floor is yours. Hi. Good morning. Good morning, everyone. Thank you for the opportunity for asking a question, and congratulations on the results. Question about the margin with the clients. The quarter was good without the offenders of the first quarter, but in the accumulated of the semester, the line is a bit below 5% against a guidance that starts at 5 and goes to 9. The guidance was kept. I want to understand where the acceleration is coming from. In the second semester, more volume, more mix, margin of liabilities, or any relevant own capital in this account. And the Selic rate and the cycle turning, how do you foresee the behavior of the margin of liabilities from now on? Thank you, Bernardo. Great to see you. Thank you for the initial words. It's a good topic, so we can start the discussion. Your question is more specific about the guidance, but I want to talk about the specific growth of the margin. We see the portfolio growing, about 10%, maybe a bit below. It should, in the next quarters, have a bit of a reduction, but it's still above the midpoint of the guidance. It should stay there. And due to the dynamics of growth, it should be in a higher threshold. There's a Colombia operation that leaves now in July, 10 billion reais of credit that allows us to grow in the previous base, and we're talking about a delta growth. Second effect, the margin as we see it today, it's growing below the portfolio. Some ask, why is the margin growing below? The explanation is the same one as the next quarters. First, when we look at the portfolio, we see the margin of assets of credit growing aligned with the portfolio. So when we open the margin, we have the credit assets, we have liabilities, we have working capital, and we have structured operations. First relevant information for you is that the margin of assets is growing aligned with the average results. In the margin of liabilities, we had in the previous years an important acceleration with the interest rates hike and an increase also in the performance. We see a strong activity. So we have a relevant growth, especially last year in the liability margin. And the price which is what we tend to analyze along with the balance. In this quarter, we have the base effect with the assets when we compare it with the first quarter. The first quarter of last year, we had the full capital, and last year we did an anticipation of the dividend, so we got into the first semester with capital with a lower threshold. That's the effect on the working capital. Fourth effect that really explains the volatility of the margin are the structured operations. LATAM doesn't really bring a lot of volatility. There is an exchange rate effect on the results, but the structured of the wholesale, they have volatility effects. So when we look at the 2 quarters, the expectation is that the range still comprises our best opinion of projections. Of course, it depends on the activity and a series of factors. Nonetheless, we can see some volatility in the margin in the third, fourth quarter, but due to the seasonality of the structured operations of the wholesale, that tend to be stronger in the fourth quarter. So when we do the projection of the margin, everything else constant, we believe that the current range comprises, it's a range, it's not a point, it comprises that. So when we see the effect of the interest rate, it had an effect of rate itself when we look at the implicit working capital in regards to the previous quarter, but when we normalize the wrap effects and also in this quarter, the working capital had a lower effect, which is selling the real estate that stays in the working capital. We see the rate of the working capital being aligned with the previous quarter. And remember, we do the long-term hedge of these operations. The liability and the working capital. Even in a cycle of interest rate, the pass through to the margin is not automatic. There is an temporal gap as the hedges are done for the longer vertices. So we depend on the activity because the activity of and liability work together. We have a cash pressure stronger, and also the individuals. The efficiency, they pressure the liabilities, they grow the balance, and the margin will depend on the dynamic of interest rates, which depend on internal, external, and amount of factors. We have everything depending on the scenario, inflation, the interest rates on the United States, so we can have a clear vision. Next question, Gustavo Schroden from Citibank. Floor is yours. Good morning, everyone. Thank you. Congratulations on the results. Quite solid. I apologize, and I'm going to insist on the issue of the question of Bernardo, but I'm going to try and bring it towards the optics of growing the portfolio. If we analyze the bank, it has a few lines, and it's focused on the private payroll, loans, small companies. So I wanted to understand what is the sustainability of this level of growth in these 3 main vectors of growth. These small and medium-sized companies always exposed to a higher interest rate that we should have, even though we are expecting cuts. We are still going to have a Selic rate higher, macro scenario challenging. The private payroll loan, consignado, is a product that has delinquency pressures. There is a cap in the interest rates. So we need to understand the size of this market. Is it possible to keep this level of growth for the next 12 months? And the real estate, when you have higher interest rates. So I really want to understand what is the dynamic of the portfolio from now on to sustain this growth of NII that is more pure of credit and a follow-up on the structured operations. Maybe we should expect a contribution for the semester, for the end of the year. So if you can clarify, what is the dynamic of the dividends that come from the quasi-equity operations that you have? They are linear? Do we have a seasonality? herein because it's more concentrated towards the end of the year. So we wanted to understand those nuances.
Perfeito. Gustavo, obrigado aí pela pergunta.
Thank you, Gustavo. Thank you for the question. Great to see you.
Deixa eu tentar.
Let me try and bring forth a few relevant events. The SMEs. We managed to grow with quality, with a great dynamics, healthy of risk management, and with a clear strategy for many quarters to grow in the government programs. It's a guaranteed portfolio. And we've decreased in the government programs, well, with the better ratings customers, we build a portfolio with them all throughout the years. It's a portfolio that has performed regardless of the challenging context, and the cost of credit and results in a profitability level are being delivered very solidly for a segment. So government still helps to withhold the delinquency at a lower threshold, but even the clients that are not in the government products, we've been growing with quality. I've explained in a presentation about the delays. I want to reinforce. We've seen a stability in these delays in the SMEs, mainly because of the mechanical issues of the deadline. Since they are, tending to zero, we have a mechanical growth of NPL. The guarantees are exercised depending on the program, depending 90 days, maybe 180 days. So they go through delays before you execute the guarantee. So there should be another 10 bips of growth. Then stability, given the information that we have right now, the scenario is dynamic. If we have deterioration, we're going to bring more information. The private payroll loan. In the previous product, you had specific agreements, 40 billion reais market. So we had 30% of the market, 12 billion reais of portfolio. It's a product that we are learning to work throughout the years by the know-how of giving it to the credit to the companies or the individuals. The private payroll loan, consignado, is the junction of these two managements. From the inception, we focus on a public that is the target audience for this product. It's a public that most of them have an account, checking account in the bank. We haven't operated in the open sea because of the delinquency that is very high. The stability of the operation is still relevant issues and some processes that need to evolve. Messages. We are growing with quality. We should stabilize the deadlines, delays, indices, similar to the previous product, and we're going to see the nominals that are going to grow. Well, the portfolio grows a lot, obviously. It's not going to grow ad eternum. It should stabilize, but we see great opportunities to produce with great risks and a dynamic of delinquency that is very adequate. Most importantly, we are running, and I presented that, we're running at about half of the indicator of the delays of the system. The data has been published recently. We're running with an indicator of delays maybe at a half. So it's an operation that creates value, generates profitability, and most importantly, we service our clients with the products that are more adequate. This is the focus. I want to be a bank focused on the client. I want to offer a product that is cheaper. And it helps to explain why the individuals, they don't grow. In the employees, we drop in 7%, and we grow. Well, there is an exchange, so we can avoid the over-indebtedness of our clients. I've brought the data that in our portfolio, our clients have performed, and the delay levels has been very well behaved. So there was the comeback of the change of the mechanics of the real estate credit, 65 directed, 20 compulsory, and 15 free resources. Of the 20 of the compulsory, 5 came back. So that generated an additional resources, and we have the real estate credit rooted in the client vision. How I service the client in the completeness of their needs in the best way possible. And given the mix that we have between treasury and savings and all the hedges that we do, we grow with quality because we see that portfolio, we need to see it as the funding comes back. The model changes next year. We have gradual releases of compulsory, 1.5% for the next 10 years. At the limit, in a time, you have two forces. One is savings more pressured. It just dropped 0.6 in this period, so it has a behavior that is stable. But you have the order strength, which is the increase to the direction that will release fundings to the market. So we still see the capacity to grow pricing correctly. If you compare it to any other banks, and I'm talking about the private ones, our return for every real margin in credit is the best given a relationship of treasury and real estate credit. We are very comfortable. Companies that depend on the capital market, we have a capital market that is more erratic over the last months. 2 months weaker, 1 more active. Up ahead, it depends on the activities which will drive our capacity to grow. Most importantly, we've been very disciplined in the capital allocation and returns. Very easy to grow portfolio with the wrong returns. When we look at the whole portfolios that we have, vehicles, big companies, we've seen the level of appetite in the market that is higher. When we see the operation of the model of return with the allocated capital and we have an accuracy level that is very high, in these models, we see that these operations are destroying the value for the shareholder when they're below capital. This is not the dynamic or vision. Even so, we see opportunities of increasing an allocation. The portfolio will continue to grow with quality. We've grown in the companies and individuals, in the best clients and the best ratings, resilient publics, and we've grown margin of assets in the same level. And what decelerated is structured and liabilities. Well, dividends, your question. It doesn't have a very clear dynamic because every company releases their dividends whenever they want. So you have to have a fiscal base to be able to operate with these operations. So this is a care that we have. The issues of the DTAs, which is very relevant. Secondly, typically the companies give dividends at the end of the year, the end of the first, but eventually there's going to be a structuring. The client needs to rescue, and they're going to pay an extraordinary dividend. It's been erratic for us, this portfolio. It's difficult to affirm how the margin will behave because since we are at any marginal operation will generate volatility. That's why we are looking at the guidance. Well, at the end of the year, since the dividend is going to be paid, then we have more surety in our operations. Next question, Beatriz, UBS. Welcome. Good morning. Thank you for the question. Our question is about efficiency. In the quarter, it's a bit higher due to seasonality, but we see a trend that is very good. Do you still see a space for an improvement in this index? And if yes, what are the main drivers? Thank you for continuous improvement. Thank you, Beatriz. Hi, Beatriz. Yes. Do you remember that in the previous quarter, we brought a bit of a view of the efficiency level and time, looking at a few segments of business? We had efficiency indices that were benchmarks and where we saw segments that are still scalable from the standpoint of efficiency indices. The efficiency index depends on the revenue. That's the focus. We see that this is the best second quarter that we had, the best first semester that we had, in the efficiency semester. There is a seasonality. First semester is where we see less expenses, and the levers are what we've seen. The application of technology, a lot of the fruits of the investments that the bank has done throughout the years, they bear fruits, and we get to an efficiency level that is very good. It's a virtuous trend. It's not from this period. If you have the longer periods of the bank, you're going to see this. We believe that this has a potential. The plans, the level of detail, the discipline that the bank has, and scalability is big, and it's what we expect for the future. And I reinforce the words of Gabriel, and yes, it's very demanding, yes.
Obrigada, pessoal.
Thank you, guys. So, Marcelo Mizrahi, BBI.
Obrigado, pessoal, pela oportunidade.
So, thank you for the opportunity. Congratulations on the results. I want to see the service line with a review of the guidance, but I wanted to understand more of the dynamics that provoke this review. And what is the strategy of the bank? That is about the issuance of credit cards, the lines of payment, the payments of companies, acquirance, and even the insurance line. I wanted to understand the service lines up ahead. But looking at the dynamic of this activity, the mix services should have a behavior that is more cautious and lower growth, maybe for next year, given the growth of cash that is potentially lower, these lines can be affected. What is in here? What is a change of strategy? The maintenance of the strategy. Do you agree with this vision? Thinking about the mix of the portfolio, the strategy of the bank, do we think about this weaker line in the next quarters? Thank you. Thank you for your participation. I think it's great that we can talk about this line because there was a change. And for every component of the services and insurance, there should be a small explanation. So, first, talking about credit cards. Specifically, individuals, there is a double effect. If we can summarize the strategy. First, throughout the years, we did a de-risking, important de-risking in the portfolio. In the incomes or the less resilient publics, we did a de-risking that is very relevant. Looking here on the rear view mirror, we lost marginally revenue. We saved important volumes of loss of credit. So the strategy was good. Second, we've been ever more focused in the high income, which is where we're growing the portfolio. And when we grow in these publics, it's a product that is clearly more expensive. We do a reduction of the payments, monthly payments. So we reduce the friction, and we are generating an operation that is completely dedicated to the vision of lifetime value, engagement with the client. You reduce the friction of the yearly rate, but the rewards are more expensive. We see the players using the credit card as a cost of acquisition of the client, making it more expensive. And in our vision, the public demands better service with best conditions. And in the standpoint of the vision of product, and this, we have the exchange in an adequate rhythm. There is a strategy with the services and insurance. A great deal of the growth has been financed with the portfolio with the interest rates, and we're using the product of credit card as a finance for the consumption and not as a product for the client that has a more deteriorated situation and has an overdraft or the payment of the credit card. There's a series of we're increasing the elasticity for the high-income clients, and we're doing this in a very material way. So this component has to be in the context of the credit card strategy, but it's in the margin of the clients. It's not in the revenue of services for the credit card. The administration of resources is very important. The per fee, even though there is a more difficult market, we are the second asset that has a good performance relative, but it wasn't good for everyone in the end. So it means that since per fee comes in the second quarter and the fourth quarter, we had a lower performance than the third quarter of last year. So it's a risk management dynamic. We hope to be in the correct side, even though with the volatility is difficult to generate per fee results. And on the other hand, we're growing the balances and the rates are kept, and that generates resources for administration. And also the consortium has helped a lot. When we talk about the investment bank, well, when we see ECM, M&A stopped, we have good, and fixed income is a better month in June. But we have to remember, we like to look at the operations of the bonds and real estate, specifically in the rankings, joining what is origination and distribution. As you can see, we are still the leaders with a big advantage in distribution, and it shows that a lot of the origination we distribute in the market. And we don't do those operations exclusively for balance. We do it by the good dynamic of the capital markets and the operations for the distribution of the market. And this is an important component to see, because these operations, when you see the result all in, which is the spread of credit plus the fee that you get, and then we've seen operations in the market that are very much below the cost of capital. So a great deal of the operations that we lost because of price, because the operation doesn't return cost of capital, and it's been years operating. It's not difficult to do the calculation of capital allocation and return. The operations that come with between 1 and 12% that destroy value in the vision of the client, but there is an important vision that depends on the dynamic of the market, and it depends on the higher risk. These returns that I'm mentioning are considering the fee, which is recognized at the end. So the risk that you recognize, that you run is big, recognizing big risks, and the duration of these portfolios might be 7 years, so you have that tied down for that time. You have an asset of low profitability because it gives 12 of return, considering 12 on average. We've seen operations below that, considering the fee. So that dynamic is bad. You recognize a fee, you do a big result, and eventually you might be recognizing the operation with a lower profitability at the long term, which is dilutive for the profitability. The other one, we try to be very careful with the credit, looking at the operations that we lose because of appetite. It goes through any reasons, but sometimes we don't do some operations because it affects the market as a whole. When we go to insurance, we've had an important component. For growth of the operation of the core, the bank assurance is doing well. What doesn't mean that that line is exclusively for our bank assurance. It brings reps and other effects. You might have some volatility there in the yearly and quarter-on-quarter, the patrimony equivalence. We have public data, and that's been displayed, and this is clear. So we can grow with a lot of quality. We've grown in the year-on-year. The premiums issued are relevant, and with the numbers very well behaved. The government has, the Social Security has an important result as well, so looking up ahead, so it depends on the activity, but every line has a different strategy. It's important that we have that vision of the client and companies. I didn't talk about the flows and receivables. It's important that we brought Rede in-house in the results of Rede. There is a double effect. First, a mix that we growed more in the wholesale than the retail, which affects the results. Secondly, the integration of the bank to the business, so we don't look at the vision of the product, we look at client. The floating in the business of Rede, it's not in this line, it's with the margin with the client. It's an adjustment that we should do up ahead, having a clearer view of the whole, and the big offender are the packages of companies, tariffs that we are reducing directionally. And the objection of this reduction is to remove the friction, increasing the lifetime value and creating long-term value. So we see the rates of engagement with the packages, and the individuals are dropping. We're generating a result that it's a third of what we generated in the past. When we did the transition, without being the bank more efficient, more focused with the client, that for the long term is very relevant. And for the future, it depends on the activities. Let's see how can we grow in this. And briefly, we will be budgeting in 2027, post-election, the space of the interest rates. They are going to facilitate the opening of some of these lines. Thank you, Marcelo. Now we have Yuri Fernandez. Good morning. Hello, good morning, Milton. Congratulations. Well, the profitability growing in less than portfolio, so quality and generation of results. But I wanted to go back to asset quality. This presentation you commented, and I just wanted to know, on the 1590 for the individuals and SME, and there is a seasonal improvement, and a part of this level you explain, which is with the government programs, but even the individuals that shouldn't have a lot of effect on that, it reflects upon it. It's not a vertiginous drop. It's going to be 10, 20 bips and it's flat. So I want to understand is if you're comfortable with the asset quality, well, things are not going to improve a lot. There is a worsening. I know that Itaú has a better balance. You're more prepared, but we are concerned, are we going to see any levels of worsening or no? This is a scenario of comfort, stability, to understand, and if you can explain what happened with the 15 to 90. Thank you, Yuri. Great to see you. First, I believe that what you felt that I tried to transmit during the presentation, you capture it very well. Evidently, the scenario, if we look at the previous quarter and the one now, the delays that are published in the products, we see a relevant increase with the over 90 delays. First information on our side, we didn't change at any point our policies of write-off for any product. The 4966 gives you liberty, but we've kept it as is. Since our expectation to take the client to write-off didn't change. We don't do that for provision or using the degrees of freedom for that. Number two, the de-risking of the portfolio that is relevant was done. Today, with the margin, we've managed to grow in a relevant way with the more resilient portfolios, with the with the individuals and the companies, wholesale retail, that has brought a lot of important results. What is a twist for the short-term delay? If you go back and look at how much we've grown, in the first quarter, in regards to the fourth quarter of the last year, in the delays, short delays, you're going to see that we grow much less than what we grew originally. So you see there, we've grown 23 bips. It was much below to what we've managed to grow. So seasonally, we see a recovery higher with the short-term debt because the first quarter seasonally is higher because of that. So we don't expect to see it. But since it was lower, only 23 basis points, and removing 23, 24 is the best indicator of the series, then we ran at 50 bips, 60 bips in previous quarter. It goes less in the subsequent quarters. So there isn't any signal. It's more difficult. We've worked with the indicators, but no signal of concern for our portfolio. Ceteris paribus, with the information that we have now, the income that is higher, interest rate that is higher, there is an over-offering of credit in the market over the years. We are very disciplined to grow in the correct way, but we are very at ease with the indicators. You can expect stability. These are volatilities, variations that are minuscule, so no type of concern. If you look at the cost of credit, the portfolio is very well. If you see the renegotiated portfolio that grows in this quarter, we have two important explanations. First is the Desenrola, the program of the government. And secondly, in the renegotiated portfolio, we have still legal proceedings of last year, and you can only consider renegotiated once the plan has been implemented legally. So when you look at the provisions, the creation is stronger now for the second quarter because it's seasonal. If you go back to the previous quarters, its behavior is very similar. From the rollout for the short to the long, it grows in creation. There is a mechanical effect. We don't do provisions with the creation. We do expected loss. So when the delay is short, we anticipate the first quarter and the second quarter. We don't see that effect. The coverage over creation that as the wholesale as a whole, since we have guaranteed products, so they demand less provisions. So wherever you see, we are very comfortable with the indicators of credit. Don't see in that any type of message. Our best estimation is stability. We don't have the best estimation for the individuals and that's for individuals. For the companies, SMEs, we should worsen 10 basis in the next quarter and then stable in onwards. With the information available now, it can worsen, but it's not what we are seeing. And in general, with all the delays, and we should bring in the next quarter, which helps to bring the indicators of the market and our indicators, it's clear how we've distanced ourselves from the market. The mouth has been very open, and we are consistent with the growth of portfolio that is very adequate and the long-term views. That's the message. Thank you, Yuri. Now for the next question, Renato Meloni, Autonomous. The floor is yours.
Bom dia, pessoal. Bom revê-los aqui. Obrigado pelo espaço para pergunta e parabéns pela execução.
Thank you for the opportunity. Congratulations on the execution. I wanted to start in a broad question. If you can tell us, Milton, about the cycle of credit in the industry in the second semester and getting into 2027. So you have how much is that helping with the interest rates in 2027? Well, with the previous comment, if you have any deceleration with the growth and the convergence for the guidance, where is that growth coming from? There is... Maybe you're going to get above the guidance. Well, thank you, Renato. The cycle of credit, we've had it for many years. It will manifest differently from the different segments and the different products in every segment. So the choice of how to give credit in a long term, and the management of portfolio is vital for what we are delivering. Because when we see the portfolio, you look at guidance, you look at macro, you look at the current conditions, you see all the models, and we had great results. We've advanced in artificial intelligence in an important results for the credit management. The cycle of credit, we've seen a compromise of income. Government programs that are various of nature, this umbrella, had an important impact. In our portfolio, it's immaterial, but it's 1.5 billion renegotiated. We presented 002 with a cost of credit. But for other players, probably the impact is higher, given the share of the program and given the public, which is less of our profile, and we also work in that public. So the cycle of credit will be challenging because United States, possibly 2 hikes on the interest rates, the curves are going to be opening. There's going to be pressure. The premium of the risk for Brazil is short term is well priced, possibly a cutoff of the meeting, which is the base scenario, but it depends on the United States. Because if the interest rates are higher, then naturally that will pull the exchange rate, and that will difficult actually the work of the central bank. That remains to be seen. So we see that these programs are helping, but they're one-offs. They're not forever. So nothing substitutes the discipline of risk management. What we see today is an excess of credit given to the market, is an excess of regulation that opened the market in a relevant way. There is a lot of players operating. There is a lot of credits for the growth of credit is in the the clients are over in debt. The clients had 4 or 5 credit cards. Now we have 5, 6 credit cards per individual. So we grow the resilient clients. We help them to do that transition in the best way possible, but it's a scenario that inspires care. For 2027, we still need to understand the real capacity. But now your final question is, why don't you seize that you have a better condition? The balance is higher so you can grow. Because then we're going to get the mistakes on the long term. So we need to have that discipline. That discipline has brought us here. So once you lose that discipline because you think that you need to grow, either to deliver results or to grow the top line, you deliver everything in the PDD thereafter. And that affects the capital and it worsens your capacity to give credit again. You're in defensive and you decrease the appetite. So we always want to be always on, giving credit with quality, but with the clients that are more resilient, always looking at the long term. But I always say, when we see the market growing irrationally, we always need to make a decision. We lose the market share, or if we are going to lose market share or money, we'd rather lose market share. So this is the adjustment of the portfolio. Thank you, Renato. Now, Daniel Vaz, Safra. The floor is yours. Good morning, Gustavo, Milton, Gabriel. Congratulations on the results, the stability, the cost of risk. A bank that is always predictable and stable. I wanted to go back to my question. Efficiency indices. We've heard with Milton, and I wanted to understand the management of the cost. I hope that is very far away from that, but there is the scenario where your revenue grows single digit. How much management could you have a cost contingency to keep the ROI? What limits the cost is it more institutional, regulatory, or simply is a deliberate choice of speed of investment, crossing with your revenue, and looking at what we are doing now. You have a review of footprint, but how much up ahead that has AI applied to your business? Thinking about what was done from now on, and now you have 100% support of AI, or do you still debate that, or is that being supported? And well, thank you. Thank you, Daniel. Thank you for the initial comments. Well, I'm going to see the glass half full. Comment that I wanted to do is, the first cost is what is in our hands. Of course, the revenue, we have a production, which is the mechanical, the portfolio. And when I look to the future, the revenue is uncertain. It depends on activity, it depends on delinquency, and so on. But the cost is under management. We decelerated importantly with the cost of the growth without foregoing the long-term view. We're never going to kill the future. We're always going to generate value for the clients, investing in experience, digital experience, and delivering a bank that is ever better for our clients. Opening new businesses, doing new fronts, all of that we're doing, but we can do both. We can invest and opening the space for that investment. I don't have a silver bullet. It's a series of initiatives that Gabriel has done with the executive committee and the bank, a deep work, all the levers, mapped initiatives. So that's where we're going, certainly. Of course, if we have technology or any other way of accelerating the process, we will do so. We are careful with the discipline of the tokens. We are never inhibiting innovation, how we're going to do the intelligent management, and so on. But efficiency for us is a mantra. It's never as important as it's been now. So with the segments that we can win competitiveness and we can advance with the market, we have 5 percentage point advances with consistency. We're going to continue to reduce the retail, adjusting the cost of service so we can be more competitive with the digital Itaú, given all the investment that we've done in technology and transformation of journeys, which allows us to service our clients with the best digital experience. And just I'm going to take a step back. In the last month, we had competitive NPS of 18 points produced by Prisma, which shows the competitive NPS for the market for the winner of the digital experiences. We closed the gap, which was 18 points through these years with the investments and the digital transformation. We're ready to capture the benefits of the digital. Gabriel can give you more information. I like the answer, starting with your question about the result, about the predictability, about the stability. It shows how we're doing things. At the end of the day, it's not difficult to grow the credit portfolio. The consequences of what's later is part of the decision-making process. So having a cost in a way that is sustainable for the clients with a series of investments that we have to do today to create value in the future. So the efficiency level is very important. It's an engine of competitiveness of the bank. But at the end of the day is the maximization of values. This is what we can do better for shareholders and our clients. There isn't one initiative. AI is a lever that is important. We are implementing we are bearing the fruits. We have initiatives that we're doing. At the same time, for you to do this, it goes through expenses. The AI expenses in the bank will increase, but it generates efficiencies, will generate revenues. So it's not different from all the transformation that we had with cloud before. It's expenses that increase, but you generate the development of the products for the efficiency of the processes in the bank as a whole. The answer of Milton is very complete, but we are doing the best that we can do with the times that is sustainable, and we can generate value for the shareholders. Thank you.
And now we are going to switch to English as we have Tito Labata with us from Goldman Sachs. Tito, the floor is yours.
Great, thanks, Gustavo. Milton, Gabriel, thanks for the call and taking my questions, and congrats also on the strong results as usual. I also want to ask you a little bit about the industry, your position in the industry. You're delivering about a 26% ROE in Brazil at a time where a lot of your incumbent competitors are struggling to do double digits, right? And there's concerns about a credit cycle, growth slowing, high interest rate environment. And how do you think about that competitive dynamics? Because that could create some incentives for some irrationality, perhaps from some of your competitors, to try to improve their position relative to yours. And we saw maybe some pressure on fees. Maybe that's related to competition. But how do you think about the competitive dynamics? We also recently saw there was an index that ranked you as one of the top 2 banks in Latin America in terms of AI. On the one hand, I think the leaders globally typically increase the gap relative to the laggards, right? Is that a scenario that we're seeing, or could competitive dynamics change right now, and could they close the gap to some extent? How do you see, given where we are in the cycle, given your position, and given where your competitors are today, your ability to sustain these levels of profitability and maybe some of the risks to that? Thank you.
Thank you, Chito. Good to see you. Thank you for your initial comments. So it's important to state at the very beginning that we have many competitors in all the segments that we operate. So if you go to the wholesale business, you have Itaú BBA, then you have incumbent competitors, other competitors for all the rankings, and competitors for credit, for cash management, for derivatives, for FX. For everything. Then you go to the wealth management, then you have other competitors for investments, for asset management, so on and so forth. And this is the same rule that applies for all the other segments. Okay. So we have, when we talk about competitors, I think the first comment I'd like to say is that we have a huge respect for all of them. And I think all of them are doing their homework, everybody trying to compete, to be more competitive in the long terms, making their investments, trying to grow. Everybody has a budget, everybody has a board, everybody has incentives. So this is life as it always was. But then we have to segment a little bit to understand, I would say, competitors behave. First of all, you're right. We've been able, fortunately, to deliver 2 digits and a strong 20 plus return on equity in the last years. And we are always trying to deliver the best value creation for our shareholders. And it depends a lot of cost of equity that today we pretty much set at 14.75. This is where we believe our cost of equity is set. Okay. So whenever we are generating 14.75 plus, we are creating value to the shareholders. If we are operating there and less than that, we are deploying capital in the wrong way. So this is the discipline we have. It's true that whenever you need to show some results, you try to grow fast and grow in portfolios and to underwrite credit in a rational way. We wouldn't be doing that because I believe this is not sustainable. And whenever we see some irrationality, and it's happening in some segments, we give one step behind and say that's okay because it's not sustainable. And you know that for a few months you will see that more clear, and then after that you will see the market being disciplined again. Why is that? Because then you will show your profits
or your revenue growing, but your profit will grow, but your return on equity will be low. And so the stock will be, at the end of the day, looking for the capability to have to create value to the shareholders. So this is very, very important for your price book and also for your price earnings. And the other thing that market will be looking at is the tangible equity of every institution, because the level of leverage you get when you have a small tangible equity, it's a huge leverage. It's not made for make mistake, because if you make mistakes in credit, you have just a small portion of our equity real capable to absorb losses. So that's why we believe it's not sustainable. Otherwise, you have to raise capital in the market more and more. So what we are seeing is that there is irrationality in some segments. This is not enabling us or preventing us to grow. We are growing and growing with discipline. But when we see that, we give a step behind and keep doing the way we believe for the long term. So this discipline is key for the long term. So when people ask me, what is advantage different that you see when you look to your market, is the discipline in allocating capital. I think this is for many years and will be for the coming years key. But we see room to grow. We see room to grow our portfolio. So the strategy, the experience, it's not only a matter of price. Clients are looking for better experience. Clients are looking for a full bank that offer you all the products. There is competitive, of course, but has a journey, a digital journey that is excellent. So this is the way we are offering the bank to our clients, and the discipline will be always here. So let's see in the coming quarters. And time is time. So let's wait and see how sustainable are those approaches.
Makes sense. Thanks.
Thank you, Tito.
Milton.
And now we are going to move back to Portuguese, porque nós temos o Eduardo Rosman conosco.
Because we have Eduardo Rosman with BTG Pactual.
Opa, bom dia, obrigado aqui pela oportunidade.
Thank you for the opportunity.
No tema
Now,
do ciclo de crédito, né?
let's go with the credit cycle and see your opinion. How do you see the system being prepared for a crisis? Economic one. The market changed a lot. The companies, the capital markets, they multiplied. And for example, the FIDIC industry, there is 100 million. That dilutes risk on the one side, but it causes changes. And we don't see how the capital markets would react to a crisis if they would go to the same direction. The individuals, they've lost a lot of shares, and we have platforms. Everybody wants to be a bank every today. So how do you compare with the previous crises, and how do you see the system for a potential crisis? Thank you, Rosman. Thank you for the question. When we see the current scenario, there is a lot of changes. Well, we have the volume of credit with the financial system. We have to look at the banking LF. Well, the volumes are very relevant. And today, we have at least 2 Itaús in credit, corporate credit in the system. And we've never had capital markets that is so relevant. This is great because the companies, they have access to market, to bank, to credit, long-term operations that in the past were public banks, now the market can absorb. But we're going to see, if we see a relevant crisis of credit, then there's going to be relevant challenges than in the past. Less banks in capital markets discussing. We've had a few cases. We've managed to somehow negotiate in a rational way with all the participants, but it's always a challenge. Second point. Regulation is key, and today the amount of players is very high. So you have a market that is supervision, the central bank does their work. They also have their budgets. And we are in favor of increasing the budget for the central bank because it's the same thing as giving credit, and we don't have the structure of, well, you open the market and then you don't have a supervision that can follow up on the evolution of the market, not by the speed, but the quality and the limitations, the physical limitations, in fact. That's an important theme that we've discussed. We defend the increase of the budget for the central bank so they can supervision. And then is the unsupervised. The neobanks, the newcomers, they bring the operations to the balance, but they distribute to the funds. A great deal of the risk goes back there. So these are capital markets, but it's a risk. It's almost a shadow bank that we have low visibility to what is inside the FIDICs. And when you have a situation of stress, who is the owner of the receivables, these are situations that come up and we are going to have to deal with that. The compromise of revenue is very high. The indicators of delays above 90 are going up. We have to see the data of the market, and the level of credit that was distributed in the market is much higher than the market could absorb. So today it's very easy to have a credit card. There is no annual fee. You can have 6 credit cards. You're not going to pay the fee. You create the effect of the sudden death. And then you go from one to the next, and then you leave the bank that is the main one. So the scenario in the individuals, SMEs, are very pressured. The level of interest rate is very concerning, and this difficult capacity of the companies of investing and paying. And the agribusiness has its challenges, perfect storm, the price of commodities, the price of fertilizer, logistics, with the war, several signs that the situation worsened at the margin. Now, market is liquid, several actors operating, internal usage coming to the funds, the first marking to the market relevant and can generate an impact, and we go through the dynamic of prices. There is volatility in the spreads of credit, but there is important thresholds that are competitive. So the market has absorbed. Those that use the window have used it well. And if you need to sell it because of a cash flow, there's going to be a hit that is very big. So that's what we're going to have to follow. But the scenario worsened at the margin, and we're going to have to see the unfolding of the structural interest rates and the economy activity. We cannot depend on the transference and the public expenses. We need to bring private investments that in these levels of interest rates, it's more difficult. Thank you, Rosman. Mario Pierre from Bank of America. The floor is yours. Good morning, everyone. Thank you for the opportunity. Congratulations on the results. Milton, going back to services. As you explained a lot, and there is the review of the guidance, but I wanted to understand what that has to do with the migration. You've talked about the migration of the clients for the One Equity. In the revenue, and we're going to have the cross-sell of products, and we have that review of the revenue that we see that migration occurred, but the benefits are not as good as we expected. How do you see that migration and the benefits for the results of the bank? Thank you.
Veja, eu acho que não, né? Não é essa a explicação.
Thank you for the initial comments, and no, that's not the explanation. We're very positive with the evolution of the migration of One Itaú that we've done throughout the quarters. First, we concluded the migration. Second, the NPS levels above 80, very strong with a small friction. 99.3% of the clients migrated with a digital experience that is very solid, and we managed to get 18 points of NPS in regards to the leader of the digital bank. The new products, more than 20 products launched in the period with a level of activation that is very strong. So transference of limits, the management of expenses, there is an adjustment of limit of the credit cards. So there is a lot of products that has important results. We quadrupled the volume of accounts in the bank. Over 70% of the clients have 3 products of the bank. So we've managed this. So the checking account is relevant, and here there are opportunities to grow in credit with a client that you knew. There is a relationship with a credit card, but you didn't explore full bank. With the private payroll loan or whatever that is in the margin with the client. It's in the growth of the portfolio, it's not in the margin of services. Credit card is there of this product, of this public, and in this public that we migrated, we did the de-risking, and it affects negatively, and we are reducing. The big reduction is done, but it doesn't grow. So it's the one that affects marginally this effect with a portfolio of services. So One Itaú is doing well. Opportunities for growth in the individuals is growing very well. The transformation of this BU, when I do an analysis of the last 7 months, it's great work with solid results, quality growth. Everything that we discussed in Itaú Day and we've communicated has been executed in an impeccable way, and the results are following. So we see the profitability generating value, segments that were more deficit. The difficult Itaú Digital is the capacity of growing in the niches with the segments with quality, and we have to get in practice. 67% of the initiatives that were mapped are going to be executed until the end of the year. We should do it, and the growth should come in the subsequent years. We're very excited about the evolution of the real estate and the natural purse and the individuals, and where we had structural programs that were very relevant, we've managed to execute it very well. I'm very excited for the future. Thank you, Mario.
Getting back to English, as we have Carlos Gomes Lopes from HSBC with us. Carlos, please go ahead.
Hello, good morning. Gabriel, Milton, Gustavo, once again, congratulations on the result and the consistency of the result, which is so difficult. I wanted to ask about one of those things that are unchangeable in life, which is taxes. You differentiate yourselves not only for the higher profitability, but also for being the bank with probably the highest effective tax rate. But when you think about it from the policymaker point of view, the system as a whole probably is paying less taxes today than they were before, and with the amortization of DTAs, possibly even more. Are you concerned that in the next administration there could be a pressure for the industry to pay more? And in that sense, what can you do to protect yourselves, either through federal ban or something else? And where could you see pressures coming for a higher taxation? Thank you.
Yeah, thank you. Thank you, Carlos. I think first answer of your question is that there is a huge stock in the market of DTAs and tax credit. So the DTA and the tax credit is a tax that was paid at a certain moment, or you have to deal with that when you go and you move for the coming year. So this is relevant. I think at the end of the day, whenever a bank has a situation of tax credit, to avoid having losses in the tax credit that will reduce from your capital base, the first thing that a bank should do is, well, to avoid doing operations that reduce your tax base. So this is one thing. The second one is to reduce the IOC. So you're not obliged to do 100% of the IOC. You can do up to, but you need to have a positive tax situation to make it happen. So I believe banks will need, in a certain moment, to adjust the IOC. The third one is the payout. So I think banks have the capability to reduce payout as well, to retain more capital if, for any reason, they will face difficult with the tax credit. But the IOC is there. I don't see any discussion about it. It's not only for banks, but it's for the whole industry. It's true that our system, our industry, retains a huge amount of capital in the balance sheet. And why is that? Because it's regulated activity. So the central bank requires that for you to make the credit and to have a portfolio the size we have, you need to retain capital. And this capital that you retain, at the end of the day, has the benefit of the IOC, but you have, in the other hand, a very high level of corporate tax rate for banks in Brazil, which is 45%, and there is an increase for financial companies in the consumer finance and also for IPs in the recent years. So I think there is no risk of this discussion because it has to do with the level of capital, and I think banks at a certain point, they will have to reduce the IOC. It's not our base case. We don't have any issue with that, but I think the market might need to reduce IOC in order to avoid having losses in their tax credit that will reduce capital. I think this is something that we might see, and this will necessarily increase their effective rate.
So you don't see any
Thank you,
public
Carlos.
discussion.
E agora voltamos para português com Eduardo Nishio, da
Now we go
Genial.
back to Portuguese and Eduardo Nishio from Genial. Good morning.
Gabriel, Gustavo, parabéns pelos resultados. Eu tenho uma pergunta mais
I have a question that is for the efficiency level. I wanted to hear from you, from your standpoint of cost and revenues. If the number of employees is dropping very high, 5.5% in the year, and in the branches we have a drop of 90%. So I wanted to know until when this process, where are you in this stage of making your footprint adequate, which is 2,000? Do you see more space for reduction? And in the part of revenues, which is difficult to make it tangible, the super app, if you can share with us a few numbers of cross-selling. Do you have those numbers to tell us? And the launching of the generative AI with the super app, what is the proposal they expect from this launch? Thank you, Nishio. About the first part of your question, when we look at the number of branches, we always do a review of the footprint from the client inwards. So a demand by the branches is dropping. The flow is a fourth of what it was. The pandemic came. There is a digitalization, and we are always reviewing our business model. Our value proposition sees how we're going to service a client. What is digital? What is remote? What is in the digital branch? What is in the remote? What is the physical? That is a part of the process. We don't give guidance on the amount of branches or headcount. Naturally, the natural turnover of the bank, as we understand that we can absorb, being more efficient and at the same time adjusting the value proposition and the business model for the clients. We're going in the first month we did a review, but we have a review of the proposal of the value, and all of that is being discussed. So we have a commitment with the client and the business model, and we have to adjust it as necessary. This is what we are trying to do, generating the minimum friction and with the most care. About efficiency, we talked about the super app. Well, the migrated clients, 50 million, are migrated. We have 70% of the clients with 50% of the products, and the opening of the volume of accounts is gigantic, which shows our capacity of delivering value depending on the profile of the client. So there is a one-size-fits-all. The benefit of integration is not only for the migrated clients, but for the shareholders, because the dedicated apps, we have a better experience than the super app. So when we integrated, we have when they are in a super app, they have a hub of credit cards that is much better than what we have before. So now these clients are part of our ecosystem. They're part of the life cycle. They're part of allowing the client to understand the full bank, and it's not mono bank, and we have solutions and for the client as they have needs, so that this growth is done obviously naturally. We're very excited with the results, and certainly an important growth of the individuals is servicing these clients better. So first, we did the foundation of creating the guardrails, the foundation of how we're doing the artificial intelligence to interact with the clients. We have a responsibility, and the institution, we cannot have the model without the protections. We have scalable models at the right price, and how can we take the results of the client in their own benefit? We have to individualize the experience, and we can do that taking into consideration the DNA of the client, and here with a degree of privacy that the client wants, having a model and without having the knowledge bases well defined. Well, we have the instructions and our policies and our culture. The agent at the end has to have the culture of the bank, and they need to have clear guardrails. So how do we train these models so they can understand the clients and all the relationship with the bank? So AI without having a full bank in the past is not in the back is not simple. You're not a one-stop shop, and you cannot make decisions making the whole. You give partial recommendations and not the best ones. Two, you don't have the records of data that we have in segments that we were always relevant, investment, credit, and so on. So that facilitates the understanding of the client in the cycle that they are. If they have assessment with we have, when can we offer, what should we offer until we get to the transactional. So you can have a transaction without involving the human. And that will clarify not only the doubts, it's AI for our for employees, because it releases time. And sometimes the commercial teams, they have to answer a simpler question. The model is going to do that. It facilitates so that the people have 3 more times contact than before. It has efficiency in the amount of clients in the account load of the teams, how many clients they have to service, and it improves the experience because you have a first call resolution that is much better as the doubts are clarified. So we're very excited. First bank to launch this with this level of completeness and this amount of data, and the models will grow with the clients. We're very excited about the evolution. And the command of the artificial intelligence AIE, it's a good position, and we are well positioned in saying that AI was always present in the bank and the brand itself. So now we're going to grow with the clients. It's going to be a game changer in the experience, and it takes the organization for a strategy that is AI first, which is very relevant for the future. Thank you, Nishio. Now the last question, Enrique Navarro, Santander. Floor is yours. Thank you. Congratulations on the result. So, the market has changed a lot. It's not normal to see Itaú, the division of guidance. And the question is, the new guidance, even the breadth of the guidance, somehow reflects this estimation for 2026. But in the quick way that the world is changing, what are the lines that are weaker in the guidance? If there is a mistake and an expectation of review, what are the lines that should be more at risk? And looking at 27, maybe you would agree that the changes that are necessary. In January of this year, the South Side, the South Side, and the banks, we had an expectation of a good recovery of the cycle of credit in 2027. And as things are happening, it's not going to work out. So I wanted to hear if we should look at 2027 and with a growth of credit that is softer, and we just have to push these banking fees that is weaker for 2027. So giving us some color at the end of 2026, 2027. Thank you, Enrique, and thank you for the comments. Last question, but a lot of energy. When we look at the range, it tends to capture well what we imagine for the year. We have a guidance, and we imagine that we are not going to need to review it, but we are pragmatic to review it whenever we have a better performance at the market. This is a good practice for transparency, so we can get to the number that we want. We don't give geographies or a point, because it wouldn't be a point, it's a range. When you see a credit portfolio, it will grow reasonably, and we have 0.6 in the portfolio. It's on the basis of the last year, and we have a selling of the portfolio that was done at the end of the day. 10 billion reais that are automatic, but again, the portfolio works very well. Margin with the client, if we annualize what we have in the first semester, is a challenge that we have for the next 2 quarters, certainly. Today, we are running close to the floor than the midterm, the midpoint, because of the effects that I commented with the liabilities that are very solid, so it grows with the structured operations that has volatility, and it might be a difference in the next quarter, and the working capital that is very stable and growing, but it shouldn't grow at a very relevant way. And the margin of assets is growing. I'm not concerned. But the margin delivers this. The cost of credit, you discussed. I wanted to tell you that a bit to the left, a bit to the right, our best expectation is to be closer than to the midpoint of the guidance. So even though if we have these questions, it's worsening at the margin, maybe there is something implicit. What we've seen in the wholesale that is more challenging in terms of credit, but we've done the provisions, And the message that I wanted to make it very clear to you is that first we do the provisions and then we discuss the profit. It's not from the profit to the provision. So if we have to come to a quarter that has a worse result because the provisions were worse, and I will explain the reasons and we will explain this. So discipline of having the provision balance, we don't forego. The balance has to be well provisioned, and we're not gonna be under provision either in the individuals or the retail or the wholesale. We're always gonna have the discipline of doing the provisions. Having said that, our best expectation is to close at the midpoint, close to the midpoint of the cost of credit. And the revenue of insurance, we did the adjustments. You see the results. We have a solid agenda. As we've seen, the level of mobilization high, and the cost is very close to the bottom. When we see the geographies, we have the full year forecast. All of that is giving me a level of bottom line. Bottom line is aligned with the guidance, previous guidance. A bit to the left, a bit to the right, but I believe that the bottom line implicit one, if it had a variation, is very small. So this is what we are seeing. For 2027, very early to say, because once again, the scenario is very dynamic. So we're going to start now with the discussion. We do the discussions, but we are going to have a good budget for 2027 with a big, we have the discipline of execution, and we're going to execute the best that we can so we can share with you. Thank you, Milton. Thank you, Gabriel. Thank you, everyone that took part on our earnings call. Now we close the Q&A session and our second quarter earnings call. Now I'll give the floor to Milton. Thank you, Gustavo. Thank you, Gabriel. Thank you very much for your participation. And we really like this relationship with the investors and with all the stakeholders. And we try to open as much as we can the information at a higher level of transparency, predictability for any direction. If we have to adjust below, we have to adjust below. If it's up, well, we try to avoid surprises. Solid quarter in a very challenging scenario, delivering the results that we've delivered with the level of profitability and efficiency level and transformation of the bank, with credit indicators and the quality level that we delivered. It's not simple. Really, this is a work of everyone, mobilization level, and a lot of capacity, not only the competency of the teams, but the capacity of navigating the scenario. And what brings us this scenario is the discipline of capital allocation, creation of value, and long-term view. Discipline is key. Thank you very much. We'll see you briefly in other opportunities. And for the YouTubers that are watching us, it's a result. The result is made by everyone. Thank you, and we'll see you soon.